Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Planet.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Yeah, let's do it. I think the place to start has to be this financial inflection point they seem to have finally hit.
Oh, absolutely. This is really the core of the whole bull thesis, isn't it? It's that moment where the high growth story finally starts to line up with actual sustainable profitability.
And the Q3 numbers, they really back that up in a big way. Revenue hit a record, what was it, 81.3 million?
Which is a 33% jump year over year. That's huge. And more than that, it crushed what analysts were expecting. The consensus was somewhere in the low 70s.
So not just a beat, but a really significant beat.
Exactly. And that revenue growth is great, but for me, the really telling number is the margin.
The gross margin, yeah.
Yeah, non-GAAP gross margin hit 60%. Now, you have to think about that. This is a company with hundreds of satellites in orbit, a huge physical footprint.
Right.
And they're pulling in software-level margins. That tells you the real value, the real profit, is in selling the data, not just operating the hardware.
That's the whole thesis right there, isn't it? They built the machine, and now they're just printing money off the data it produces, and that's flowing right down to the bottom line.
It is. Q3 was their fourth straight quarter of positive adjusted EBITDA, pulled in about $5.6 million.
And maybe even more important for the long-term story is the free cash flow.
Yes. Third quarter in a row being cash flow positive. It's not a huge number, just under $1 million, but they're sitting on $55 million in free cash year to date.
Which is just key. It completely de-risks the story. They're not a cash-burning machine anymore. They're funding their own growth.
And when you talk about de-risking, you have to look at the visibility. This isn't one-off project work.
No, it's sticky. 97% of their Q3 contract value was recurring. That's incredible predictability.
And that predictability stretches way out. Look at the battle line.
That number was just unbelievable. It nearly tripled.
Tripled year over year to $734 million, a 216% increase.
And we should probably explain that other number, the RPOs, because that was even more dramatic.
Right, remaining performance obligations. It's just the pile of money from contracts they've already signed that they still have to deliver on.
It's future revenue that's already locked in, and that jumped 361%.
To $672 million. So, a huge chunk of their revenue for the next couple of years is already basically in the bag.
Which lets management be really confident with their guidance. They bumped up the full-year revenue outlook
to between $297 and $301 million. And crucially, they're guiding for a full year of positive adjusted EBITDA.
So they're showing everyone, look, we can be profitable and we're still investing heavily in growth.
Which brings up the next question, right? If the financials are this good, their competitive moat must be getting deeper.
It has to be. You don't get these kinds of numbers by accident. It's not just about launching satellites anymore.
Not at all. I think their moat is really built on three pillars. You have the sheer scale of the data they collect, the fact that they do it daily across the globe, and then this software and AI layer on top.
They just have the biggest constellation out there. Nobody can really match that fire hose of historical and current data.
And they're not stopping. The new OWL constellation is a really big deal.
So what's different about OWL?
Well, it's designed for near-daily, 1-meter class imagery of the entire planet's landmass. But the key is the edge computing.
So they can process data on the satellite itself?
Exactly, before they even send it down. That's a huge step up from competitors where you have to ask them to point a camera at a specific spot and wait. Planet is moving towards providing constant, ready-to-use information.
And that's what makes them so sticky with their government clients.
Oh, totally. The recurring revenue is all driven by these big multi-year contracts with the U.S. and its allies once you're plugged into their intelligence workflows.
You're not getting unplugged easily, and a cost to switch would just be astronomical.
And we're seeing that lock-in with the big contracts they just announced. A $12.8 million deal with the NGA.
The $13.2 million renewal from the NRO.
And that's $7.5 million from the U.S. Navy for watching ships in the Pacific. These aren't just sales. It shows they are a core part of the national security apparatus.
And they keep moving up the value chain, right? It's not just about the satellites. They bought that AI company, Bedrock Research.
And they've got that R&D project with Google. It's
Yeah.
all about moving from being a data provider to being a decision intelligence platform. They're not selling pictures, they're selling answers.
Which they can fund themselves because the balance sheet is just so strong.
It's a huge advantage. They raised that $460 million in debt and ended the quarter with almost $677 million in cash and investments.
That's a runway for years. They don't need to go back to the market for money anytime soon.
Right. Their net debt is basically negative. Compare that to other space companies that are constantly diluting shareholders to fund the next launch. Yes, their CapEx is high,
About 80 to 85 million for the year.
but it's all strategic. They're pouring that cash back into the things that grow the moat, like Owl, Pelican, and all their AI work.
It's the right move, using their strength to solidify their lead. Now, we have to talk about the stock price because the market has definitely noticed this inflection.
Noticed is an understatement. The move has been absolutely explosive.
It hit a new 52-week high, 1675. Zoom out, and it's up, what, 650% year over year?
And about 350% in just the last 6 months. This is a major re-rating. The market is finally buying the SaaS story.
Technically, it looks super strong, firmly above the 50 and 200-day moving averages. It just screams institutional buying.
For sure. But after a run like that, we have to, play devil's advocate a little. The first red flag has to be valuation.
Yeah, even with the adjusted profits, it's trading at a pretty rich multiple.
And that's where the bear case gets its teeth. I get the focus on adjusted EBITDA, but if you look at the actual GAAP net loss, it's big.
59.2 million in the red for Q3. And that loss was actually bigger than last year. So how do you square that?
That's the tension in the stock right now.
Yeah.
The market is clearly choosing to look past the GAAP number. They're saying the non-cash stuff, like stock-based comp and depreciating old satellites, doesn't matter as much as the cash generation and the huge backlog.
So it's a bet on the future cash flow, not the present day accounting.
Precisely. But that GAAP loss, it means the volatility is going to stay high. The risk is still there.
And there was another risk, or at least something that looked like one. The insider selling.
All right, the CEO, Will Marshall, sold about $3 million worth of stock.
And another insider sold over $1 million worth. That can definitely make retail investors nervous, seeing the guys at the top cashing out.
It's something you always have to look at, for sure. But the context is everything. The stock just ran up over 500%.
So it's probably just taking some profits, diversification.
I think that's how the smart money saw it. I mean, analysts actually raised their price targets after those sales were reported. They saw it as a non-issue compared to the big picture.
Okay, what about the other big risk? Customer concentration. They rely so heavily on government contracts.
It's a valid concern. If budgets shift, it could hurt. But the best counter-argument to that is the backlog itself.
It's not just renewing, it's expanding.
Exactly. A 216% jump in backlog shows the government is doubling down, not pulling back. And they're trying to diversify with things like the Tanager 1 hyperspectral data for commercial clients in mining and agriculture.
So looking ahead, what are the catalysts we should be watching for?
Well, the most immediate one is the Q4 earnings report. That should be out around early to mid-March.
And the market will want to see them confirm that full-year positive adjusted EBITDA guidance.
That's critical.
Yeah.
They have to deliver on that to keep this momentum going. And on the product side, we're looking for more progress on deploying Pelican, SuperDove, and Owl.
Plus seeing if they can get real commercial traction with Tanager.
For sure. And you can't ignore the macro environment. Geopolitical tension is unfortunately good for business. Demand for persistent monitoring is only going up.
Okay, so let's get into the more speculative upside. You mentioned the R&D work with Google.
Yeah, I think there's a real chance that could turn into a much bigger commercial deal.
You mean like integrating Planet's data directly into Google Cloud or Google Earth Engine?
Can you imagine? That would be a game changer. You would expose their data to millions of developers and enterprise users instantly.
That's a huge potential catalyst. But let me throw one more out there, a really big one. M&A.
An acquisition.
Think about it. Planet is basically becoming the essential operating system for Earth observation data. It's a strategic asset. What would a defense contractor like Lockheed or a cloud giant like Amazon or Microsoft pay to own that?
That's a fascinating thought. So we pull this all together. It seems like Planet really is making that difficult transition from a capital-heavy satellite operator to a high-margin, AI-powered SaaS company.
It does. The market is pricing it like the core OS for Earth data, and that massive government backlog gives them a solid foundation to build on.
The main risk is just the valuation after this massive run, but the fundamentals look incredibly strong. This doesn't feel like a short-term trade.
No, it feels like a multi-year hold, but maybe you wait for a pullback to start a position or add to one.
That's all the time we have for today's analysis. If you enjoyed this conversation and found value in our insights, please subscribe, like, and comment to support our work. We'll be back tomorrow with another stock.